The world is a volatile place. Geopolitical tensions simmer, trade disputes erupt. Every day the news is filled with stories of conflict and uncertainty, making it difficult to predict what will happen next. Economic growth sputters in some regions while it surges in others. Some cities are booming with activity, while others face stagnation and decline. This uneven growth creates a complex landscape for investors. It's no wonder investors seek safe havens. They are constantly on the lookout for strategies to protect their investments from the unpredictable nature of global markets. They want to protect their wealth. In times of uncertainty, safeguarding one's financial future becomes a top priority. Consulting with financial advisors and securing assets in reliable forms are common steps taken. They need assets that hold value when others falter. Gold and other precious metals have long been considered reliable stores of value, especially during economic downturns. During times of economic uncertainty, investors look for stability. They seek out assets that have a proven track record of maintaining value, even when the broader market is in turmoil. They turn to assets that have historically weathered storms. Historical data provides valuable insights into which investments have stood the test of time. These assets are known as safe havens. Gold, silver, and U.S. Treasury bonds are classic examples. They are trusted for their ability to retain value. But what makes a good hedge? It's not just about choosing any asset, it's about selecting the right ones. A good hedge is an asset that tends to maintain or increase its value when other investments decline. Diversification is key. By spreading investments across various asset classes, investors can reduce risk. It's a way to diversify your portfolio and mitigate risk. A well-diversified portfolio can help cushion the blow during market downturns. There are several traditional safe havens, including gold, silver, and U.S. Treasury bonds. These assets have a long history of providing stability. In recent years, cryptocurrencies have also emerged as a potential hedge, although their track record is limited. While digital currencies like Bitcoin and Ethereum offer new opportunities, they also come with higher volatility and risk. As the financial landscape evolves, so do the strategies for seeking safe havens. Investors must stay informed and adaptable, continuously reassessing their portfolios to navigate the ever-changing economic environment. In these uncertain times, the quest for safe havens is more crucial than ever. By understanding the options and making informed choices, investors can better protect their wealth and secure their financial future. Gold has been a safe haven for centuries. It's a tangible asset that has stood the test of time. Unlike paper money or digital currencies, gold is something you can physically hold and see. You can hold it in your hand, feel its weight, and know that it has intrinsic value. This physical presence gives investors a unique sense of security that other assets often lack. This gives investors a sense of security. Gold is durable. It doesn't corrode or tarnish over time. It's also scarce. There's a limited supply, which makes it even more valuable. These factors contribute to its enduring value. Over centuries, gold has maintained its worth, making it a reliable investment. Throughout history, gold has held its value during times of economic turmoil. When markets crash and economies falter, gold often remains a stable and reliable asset. When currencies fail, gold often remains strong. It acts as a financial anchor, providing stability when other investments falter. Investors turn to gold when they lose faith in paper money. In times of uncertainty, gold is seen as a safe harbor, a place to protect wealth from the volatility of the markets. They see it as a store of value, a way to preserve their wealth for future generations. Gold's enduring appeal lies in its ability to retain value over long periods. This is especially true during periods of high inflation. When the cost of living rises, gold often becomes even more attractive. When prices rise, the purchasing power of fiat currencies erodes. People look for alternatives to protect their savings. Gold, however, tends to hold its value. It acts as a hedge against inflation, maintaining its worth even as other assets lose value. In fact, it often appreciates during inflationary periods. This makes gold not just a safe haven, but a potentially profitable investment during economic instability. Recent trends show a renewed interest in gold. Wealthy investors are increasing their gold allocations. They see it as a hedge against economic uncertainty and geopolitical risks. Central banks are also adding to their gold reserves. This signals a lack of confidence in the global financial system. Gold is not without its critics. Some argue that it's a barbarous relic. They say it doesn't generate income, but gold is not about generating income. It's about preserving wealth. It's about having a safety net when other assets tumble. Section 4. Silver, a similar yet different story. Silver shares some similarities with gold. It's a precious metal, valued for its beauty and rarity. Like gold, silver has been used as a form of currency for centuries, and it continues to be a popular investment choice for many. It's also a tangible asset, meaning you can physically hold it in your hand. This tangibility gives many investors a sense of security, knowing they own something real and valuable. However, silver is more volatile than gold. Its price can fluctuate significantly over short periods. This volatility can be attributed to several factors, including market speculation and changes in industrial demand. This is because it has more industrial uses. Silver is a key component in various industries, from electronics to solar energy. Its unique properties make it indispensable in manufacturing processes. When the economy is strong, demand for silver increases. Industries ramp up production, leading to higher consumption of silver. This increased demand can drive up its price. This drives up its price, making it a potentially lucrative investment during economic booms. But when the economy weakens, demand for silver falls. Factories slow down, and the need for silver diminishes. This reduced demand can cause its price to drop sharply. This can lead to sharp price declines, causing concern among investors who may see their investments lose value quickly. Despite its volatility, silver has historically performed well during periods of geopolitical and financial uncertainty. Investors often turn to silver as a safe haven during turbulent times. For example, silver surged during the 2008 financial crisis. As the stock market plummeted and economic instability grew, silver's value increased significantly. This is because investors see it as a safe haven asset. They believe it will hold its value when other assets decline, providing a buffer against market volatility. They believe it will hold its value when other assets decline. This belief in silver's stability during uncertain times makes it a valuable addition to a diversified investment portfolio. Section 5. The industrial demand dilemma for silver. The industrial demand for silver is a double-edged sword. On the one hand, it provides support for silver prices during economic expansions. On the other hand, it makes silver vulnerable to economic downturns. When industrial activity slows, demand for silver falls. This can lead to price weakness. Investors need to be aware of this dynamic when considering silver as a hedge. If you believe the economy is headed for a recession, silver may not be the best choice. However, if you believe the economy will continue to grow, silver could provide upside potential. Section 6. Cryptocurrencies, a new frontier with new risks. Cryptocurrencies, such as Bitcoin, are a relatively new asset class. They are digital currencies that use cryptography for security. Proponents of cryptocurrencies argue that they are a hedge against inflation and currency devaluation. They point to the fact that cryptocurrencies are decentralized. They are not subject to government control. However, cryptocurrencies are also highly volatile. Their prices can fluctuate wildly. This makes them a risky investment. Additionally, the regulatory landscape for cryptocurrencies is uncertain. Governments around the world are still grappling with how to regulate these digital assets. This uncertainty creates additional risk for investors. Section 7. Navigating the uncertain waters of finance. The best hedge against economic collapse depends on your individual circumstances and risk tolerance. Gold is a traditional safe haven that has stood the test of time. Silver is more volatile but may offer upside potential. Cryptocurrencies are a new frontier with both risks and rewards. Before making any investment decisions, it's essential to do your research. Consult with a financial advisor. Understand the risks and potential rewards of each asset class. And remember, diversification is key. Subscribe and stay savvy. Don't put all your eggs in one basket.